Thanks for joining me on my market report. My name is Mike, and if you're new to my channel or my videos, we create these videos on a daily basis on what's impacting mortgage rates. We kind of get into stuff like economic data gets reported, or headline news, or sometimes sentiments in the markets that may um, impact mortgage rates. Sometimes good news is bad news, and if you're on the sidelines, you may not understand what's going on and why it's reacting the way it is. So we're kind of here to kind of give the explanations for you folks. So if you're out there in the real estate industry trying to figure things out, we're hopefully giving that information out to you so that way you kind of have a better understanding of what's going on with mortgage rates. And then also, if you guys are looking to refinance or purchase, you guys might be keeping your eyes on where rates are moving and might want to get some information as well. Hopefully these videos will provide you that information that you're looking for, and hopefully help you make better decisions for what you're doing. Without further delay, a little bit about myself is I am a loan officer. I do work with the national lender. We do loans in all 50 states. So if you guys are looking to refinance or purchase, we can certainly help you out with that. But we're also here as a resource for you folks if you guys are looking to got questions about programs that might be available out there, or about mortgage rates or stuff like that. If you guys got questions, please feel free to reach out. We're here to help you guys and want to make sure you guys get the information you guys are looking for. Uh, so without further ado, we'll start off with the economic calendar. I'm going to go to a different page here just because it has a little bit more information. Um, so every week, every Wednesday, we get the MBA releases their mortgage loan activity report, and today we get that. So from last week, we had an increase in the purchase mortgage application. So we saw an increase in our purchase applications. And then also in the refinance, so we had a slight dip, not by much actually, but a slight dip, which is kind of surprising because we had a big spike in our interest rates last week. So maybe we'll see more of that dip next week's report. But we had that big spike last week coming in for refund, so that should have affected the refinances. But here's the big report we're looking for. We're looking for the CPI report. We'll start off with the headline news here for month over month. So this is for the month of December. So November rose 0.8%. Forecast is coming for 0.4%, and it came in a little bit higher at 0.5%. So that brought its year over year from 6.8% in November, with forecast at 7%, and coming in at forecast at 7%. Now, when you strip out food and energy, which are two variables that we cannot control, we kind of get into what they call the core CPI, and it's a monthly increase back in November at 0.5%. Forecast count for the same trend at 0.5%, and came in a little bit higher at 0.6%. So that brought its year over year from 4.9%, with a forecast count for 5.4%, coming a little bit higher at 5.5%. So obviously, last thing we want is too high inflation. The Fed usually likes to keep inflation around 2%, so we're well past that, and this is why there's a lot of talk out there in terms of what the Fed's actions will be. So we've already talked about the Fed increasing their tapering pace, so that way they're wrapped up by March, and then they think that a lot of investors believe that the Fed will start pretty much almost immediately afterwards, start hiking rates to stave off inflation. That's usually the biggest tool that they use to stave off inflation is raising rates. So the dot plot we saw back at the last meeting showed 3 rate hikes this year and 3 rate hikes next year. But a lot of investors, I think, that feel that the Fed may actually be a little bit more aggressive, and they think that there could be 4 rate hikes this year and 4 rate hikes next year to stave off the inflation. So we'll have to kind of wait and see, but that's kind of getting to be more and more accepted in the markets as reasoning. So you're seeing a lot of chief economists out there talking a little bit more. They think that there's going to be a Fed will be a little bit more aggressive than what was already been kind of displayed. Then also the next question will be the normalization, so rebalancing their portfolio, because initially it sounded like they were going to go ahead after a couple rate hikes, then they would start with that, but they were talking about passive, which means that they were going to go ahead and as soon as they mature, they just don't reinvest that money. They just kind of let them fall off the portfolio and not add to it, and then subtract by that way. But now they think that they could be a little bit more aggressive and go ahead and start selling off some of those portfolios. Now, if that comes to fruition, that could be bad for bonds because that means more and more being added to the market, and that means there's just probably not going to be enough demand out there, and that could hurt us over the long term, uh, unfortunately. Now, last but not least, we do got the 10-year auction, which could affect mortgage rates. That will be coming in a little later today. That could play a factor of where mortgage rates go. But it could also help us a little bit. So, and I'll touch on that in a little bit here. So why don't we jump over to mortgage MBS right now, see what mortgage rates are doing. We did have a rollover, which is why it seems like this is lower than what the other is. And what that means is roll around every month we get what they call a rollover, and that's basically a reset in the pricing in MBS, and that basically means that there's no change in pricing or rates for our rates. It's just that they repackage those loans for the next month. So the loans that they are now collecting for this month will be going into next month. So these will be February's, whereas now they just wrapped up January's, January's mortgage rates, and now we're going to be working on towards February's mortgage rates, and that's why we get these 30-day locks. So about every 30 days we get these rollovers, and it's a reset in pricing. Again, it doesn't affect mortgage rates or anything like that. So on the charts it looks kind of funny a little bit. So just to give you FYI, right now we're up 14 basis points. What that translates is that is enough of an improvement to give us that better pricing for mortgage rates. So we'll have a little bit of improvement. Yesterday we did close up 8 basis points, which helped us out as well. So we had an improvement in our rates yesterday and then today. So that's going to help out pricing for mortgage rates. Here's today's volatility. So as you see, we saw this kind of spike upwards. It did come down, kind of spike up. It came back down. It came up. So a lot of volatility in today's pricing, and a lot of that has to do with the CPI report, primarily because CPI is consumer inflation, and that's the biggest enemy to bonds or mortgage-backed securities. Now, but right now it's kind of showing that they're kind of shrugging a little bit off, but then they want to take it into consideration. So a lot it has to do is that the reason why it's in more of a positive territory is because, for the most part, it is priced in. We've had that huge cut last week, that big drop as you saw right here, and it continued a bit this week. But it's kind of in more of a correction mode right now. It looks like we have a potential for a correction to kind of reset that a little bit, come back a little bit, and maybe come closer to our 25-day moving average. Now we may not get fully up here, but we may get some improvement here in the near term. So just be prepared. That is a possibility. But today we do got the 10-year Treasury. Again, that could affect rates. It could worsen or it could even improve. So we'll have to wait and see what the appetite on the auction is. So speaking of such, this as we talked about, this technical level at 1.77 level has been helping us out. We've tested it, pulled back, tested, pulled back, tested. About 3 days in a row there, from Friday to Monday, Tuesday, it tested, came back, and now we're down to about just under 1.72. Now, if we could break below this, and hopefully if the 10-year Treasury comes in positive, that could help us break below this and help create a little bit more liquidity and improve mortgage rates a little bit further. So we'll have to kind of wait and see a little later today. As you can see, this will be at 10 o'clock Pacific Standard Time. So probably about another 5 or so minutes, we'll be seeing that coming in shortly. But regardless, again, we'll have to wait and see. We could have some volatility coming in. All right, so last but not least, we'll start off with the average rate for conforming loan limits, and we'll start off with looking over here at 30 years now at 3.59, and the 15-year is at 2.85. So as you can see, we are seeing rates rise a bit. So, and if you guys have been following my videos, you know that rate quotes aren't one size fit all. They do a lot of variables that go into factoring what a rate is. So if you guys are looking get some questions on rates, please feel free. We can certainly quote you some rates if you're looking for some type of rate quote. All right, folks, if you guys like these videos, please help us out and smash that like button and share us. We greatly appreciate folks. If you guys got questions, again, please reach out. We are here to help you guys out. In the meanwhile, thank you so much for watching, and we'll look forward to see you guys in tomorrow's video. Have a great rest of your day. Bye-bye.